I still think we're in the latter stages of a 42-year secular bull market that started in August of 1982. It's been an amazing run, and particularly this last since October 2022, it keeps going. And you get these pullbacks, but I think it's going higher. The economy, surprisingly, is resilient. We have such big leverage in the system. Leverage, as I define, by 320 trillion in global debt, 35 trillion in U.S. government debt, way beyond anything we've ever seen in any previous cycle. If you have that kind of leverage, that means you have tremendous risk in the system. There's a huge amount of things this fall to worry about, not the least of which is an election in another month here in the U.S. But my view hasn't changed. I still think we're in the latter stages of a 42-year secular bull market that started in August of 1982. It's been an amazing run, and particularly this last since October 2022, it keeps going. And you get these pullbacks, but I think it's going higher. The economy, surprisingly, is resilient. I mean, as you know, probably for most of this year, there's been concern that the economy was heading south and that it would not stay up, and therefore the market wouldn't go up. And yet here we are in the estimate for the third quarter now looks like it's 3% or above. May surprise and come in lower than that. But, I've been one of those that's been saying we could even be in recession now. And surprisingly, in spite of what GDP is pointing to right now, the way revisions come in, they've just revised upward. But because we have a have and have not economy, at the very least, a big chunk of the economy is already in recession. Whether statistically we're at 3% GDP or whether that's going to get revised down, I don't know. But you're still looking at an economy where the top end is doing very well, but there's signs of slowing, and where the bottom end is struggling just to meet their basic needs. And that tells me we're continuing to move towards trouble. But that being said, the economy is still doing fairly well from a statistical standpoint, and allows the street, Wall Street, and investors to say we're looking at a soft landing. So from that perspective, it's quite positive, because what we've had is 2.5 years of tightening and basically 4 years since the last rate cut. And yet we have an economy still chugging along. So it looks like Jay Powell and his crew performed the miracle and basically took care of what they needed to take care of to get inflation down to their target or close to it without sacrificing the economy. If he does that, that's beyond most people's expectations. And for at least for now, and I think through this fall, maybe through this year, that's going to be the story. I think that's the narrative, is that you have a Fed that now says we can ease because we're, number one, way behind the market. Based on market rates, the Fed could still cut rates another 100, 150 basis points. The Fed fund rate going from 5.5 to 5 is not going to all of a sudden instantly put money in people's pockets or instantly tell businesses it's time to, gear up and go. All it is a signal that the Fed is beginning to get it, that the Fed is understanding that maybe the tightening is done and that it's time to move in the other direction. The markets, being forward-looking and forward-looking by many months, take that as a signal that there's if we've had a 2.5-year tightening cycle and we're beginning a new easing cycle, that means a long runway ahead of ever lower rates. So that's why that is important. The 50 basis points, it could have been a quarter, and the Fed, and it probably would have still signaled that, but it would have also signaled that the Fed was underestimating the need to turn around here and go the other way. So I think the 50 sent a signal that they are on the case. They're still behind, in my opinion, but they're at least understanding that it's, we can't go too slow here. Now, then you get the central bank's trying to walk it back, and Powell or some of his minions, they don't want the market running ahead of them. They're trying to keep the market in balance where it's not going to get ahead of expectations aren't going to get ahead of what the Fed's ultimately going to do, and then you have disappointment. So they're trying to kind of say, slow it down, guys. We're not even sure we're going 50 next time. We could if conditions dictate, but we don't know yet. So don't you decide and that's the game they play in terms of messaging. But in terms of rates, what it really is, it's the signal of a long runway ahead. And I might add to that, it doesn't get talked a lot about in the markets, but everybody treats ease as rates. The true easing is money, and they're still shrinking the balance sheet. So in some ways, I could argue that they're not even easing yet. Yes, the signal is that they're beginning to ease and rates are coming down, and they're going to come down, I think, quite sharply in the next year. But there's another piece to this, which is when are they going to finally join that rate cutting with expansion in the balance sheet, or printing of money, and that is a risk, because I think the mindset, not only with the Fed but all central banks, is we went crazy the last decade with what we did, because 2008-9 was so bad. We went crazy with expanding our balance sheets, and with basically 0% money, keeping the rates so low for too long. And they're basically fighting that war now. They're fighting the last war of saying we're not going to do that again. And Jay Powell's been very clear about that I have no intention of, number one, being the Fed put that is always worried about propping up the market. We're not doing that anymore. We're focused on the economy and inflation. But also, I think they look and say, the economy's okay. Why do we need to print money? And we're, in fact, because of the pandemic, we increased the balance sheet by $5 trillion. I actually raised my price target on gold in the last month to 3,400. When it was down, just about to break out, or down below, I think it was down around 25 or under 25. I raised it to 3,400. So I'm now saying we'll see 3,400 gold before the bust. So it doesn't necessarily coincide. People want everything to fit in a neat package. So they go, will it top out exactly when the stock market tops out? I said, it's coming from farther away. So more likely it tops out a few months later, but tops aren't something where you go up one day, tick the top, and then go straight down. Tops can take months to build. So, it doesn't mean the stock market's going to be down 20% while gold's going up. But I think that the top in the stock market could be this year, whereas the top in gold might be a few months later. Could happen faster, but and silver, I have a target. I raised it back in July. In my July letter, I raised it to 75. So it had been 60. So I think, and it will coincide with gold. So I think gold and silver are just getting going. In the very short run, I wouldn't be surprised to see silver down and gold down another $50, $50, $60. Silver maybe down a couple bucks. Doesn't have to, but I wouldn't be surprised if that's the setup looks like that could happen here in the next week. And then it's off to the races. And I mean that. You've got a huge run ahead where, silver obviously from $30 to 75 is a big run. Gold from, might get down under 2,600 or around 2,600 and go to 3,400 is a big run. And by the way, just to kind of fill it out, I know you're going to end this, but I still have a 7,000 target on S&P. Yep. I raised my target on the NASDAQ to 24,000, I think in July. I raised my target on, I think probably was there when we last talked, but my target on the Dow was 55,000. I raised it, I think, back in January, so that was probably the target back then. And the Russell 3,300. So, I mean, we still have a lot of upside. As I tell people, it's a funny period because you could have that all happen in the next few months or less. because it can be parabolic. But it's normally years worth of returns. If you go from 2200 on the Russell, it's more than a 50% return in what could be 3 months or less.
Yeah.
And NASDAQ not quite that big, but still a big return, 40%, and the S&P 25-30%. So you have to be careful because you're near the end and the risks are huge on the other side of this mountain. But the returns that are still on the table are big enough that I think for people that can be at least a little nimble, you don't want to just get bearish here. There's a huge wall of worry. There's a lot of worries there, and we didn't even talk about the longshoreman strike or the election.
Yeah.
But there's plenty to worry about. But it's that wall of worry and the skepticism about this market that keeps me bullish. The vast majority of both more institutional investors really don't believe this market. They think they got 1 foot out and they're looking for the exit. That's not the sign of a top.